Hey guys, Toby Mathis here, and today we're going to be going over the pros and cons of different types of business entities. So I'm going to dive right on in. We're going to be going over four major types of entities today, and I'm going to give you kind of a layout of the land. I'm going to share one of my little screens here that will show, let's see, my whiteboard, so you can actually see it. And I'm going to map this out for you really kind of in broad strokes so you can understand exactly what we're talking about. So I use quadrants whenever I start talking to somebody about asset protection planning, tax planning, legacy planning, business planning. And the reason I do that is because we really exist in the different types of activities that we undertake in four different planes. And the first one is your personal realm. This is where, this is you and your family. I'll just put you, your house, maybe your car, your stuff, maybe your checking, maybe your checking accounts, savings, your stuff, IRA, your life insurance, all this stuff that's tied to you and is in your personal realm. And I just kind of look at it and say, hey, it's on the left side of the chart. Then you look at your businesses, and this is your active businesses. And what you realize is that this entire side over here is what I call active. This is sweat of your brow. These are the things that you are doing that create income. So this isn't an investment. This isn't your real estate. This isn't your stocks and things like that. But this is active businesses that you are undertaking. So, for example, you may have your management entity if you have significant holdings. You may have your side business, side hustle. You may be a consultant, so your primary biz, whatever it is, it's yours. You're the one doing the activity. Then you're sitting over here on the active business side. Then we look at the passive side. And I say passive. I'm a tax attorney, so I know that actually has a meaning. Passive, not from the standpoint of, because there's only two types of passive income businesses in which you don't materially participate in rents. I'm talking passive that you're not having to do the work. And that's where you have like your brokerage accounts. This is non-risk. Owning these things do not create risk. So you might have brokerage, your bonds, an interest in a business, kind of like a passive business that you're not working in. Maybe your syndications, things like that, can go over here on that passive side. And it's not creating risk. In other words, the asset itself will never cause you to get sued. In other words, if I own shares in Microsoft and Microsoft does anything wonky, I don't get sued because I own shares in Microsoft. I didn't do anything. So I am passive on that side. And then we have risk assets. And this is rental real estate. Now, why am I bringing this up? Because the types of businesses that we're going to be focusing on today are over here. There's also this. Some people act as a sole proprietor and they don't realize that they're literally, there's no lines around them. They and their business are the same thing, and we'll discuss that in a second. So we're really talking about active businesses. So when you hear me talking about the different entities, understand that I'm not really hitting on these guys over here. We're not talking about those of you who are landlords and those of you who are stock investors. We're talking about if you were a plumber running your pizza company, you have a side hustle that in you're operating as a consultant on the side, or a real estate agent, fill in the blank. We're talking about you guys. We're not talking about being a landlord. All right. So let's go over what we're going to be discussing. And I'm going to make kind of a chart here. Excuse me, because I'm just hand drawing this stuff, but we're going to call these the entity types. And we're going to go over sole proprietor. So I'm just going to call it sole prop. We're going to go over partnerships. We're going to go over S-Corps. And we're going to go over C-Corps And I'm going to rate them on 4 different areas. So I'm just going to say, I'm going to rate them on 4 different areas. And I'm just going to list these out. I'm going to call this one asset protection, tax, so minimizing tax. We'll call it business planning. So business planning, is it going to help you engage in business, be taken serious, get access to different types of financial services, loans, etc., easy to raise money. And then the last one is legacy. And by legacy, I mean estate planning. Is it going to be easily passed to your heirs? Is it something that makes it simple? And so we're going to go through each one of these. We're kind of going to go the pros and cons of each one. And then I'll come back and do the little checklist. And so I'm going to make that go away for a second. And then we'll come back and go over it after we've gone through the various types of entities. All right. So the first one is a sole proprietorship. And the easiest way to think of a sole proprietorship, it's you. There's no difference between you and your business. In other words, you just decide one day, I'm going to be a business. And people have a difficulty distinguishing between where Toby ends and Toby's business starts, because they're all commingled. Usually you're using the same bank account. You're just putting a name on something. You do a DBA or fictitious name statement, and let's just say it's Toby's Plumbing. And there's no difference between me and my business. So it's just, again, literally the business. Everything goes on my personal tax return. It's called a Schedule C, and it's a sole proprietorship form. The bank accounts quite often are all commingled up, and there is no liability protection whatsoever because you are your business. And so let's kind of go through the high level pros and cons, and you'll realize the reason people use sole proprietorships so much is because they're so easy to create. Like, all I got to do is decide, hey, I'm going to be in business one day, and I do it. So they're very, very easy to form. Inexpensive. I don't have to file it with the state anywhere. Sometimes I go if I want to run with a different name other than myself, like I could just be a sole proprietor and just be Toby. But if I want to be Toby's Plumbing, then I should go get a fictitious name statement and a business license and run around, and I could start business tomorrow. And it's going on my personal tax return. I'm going to allocate it and say, hey, some of these expenses are business, and I'm supposed to track who, what, where, when, and why. Like, who am I paying the expense to? What was it for? Was it part of a profit-making endeavor? All those things. And there's lots of little rules that are out there to trip people up. And one of the little secrets that you don't know, tax attorney, been doing this over 25 years, is the IRS loves sole proprietorships because they win against them at a pace of 94 to 95% of the time. In other words, you think you're in business. The IRS says, I don't think so, and then applies the exact same rules that they apply to corporations and partnerships to you, even though somebody told you didn't, no, the rules are different for everybody. No, the IRS does not distinguish. You need to be able to show what the expense was, why it was incurred, what it was paid, who was paid, and keep a paper trail, your books and records of it. And it doesn't matter whether you're a C-Corp, S-Corp, partnership, or sole proprietor. It's the same requirement. People don't do it as sole proprietors because somebody told them you don't have to. Oh, the formalities aren't nearly as high as that of an S-Corp. And that's just not true when it comes to the IRS. So they end up getting smacked. It's a really high audit rate. It's about 800 to 1,600% more likely to get audited than partnerships or S corporations, and they lose. Again, the average is 94 to 95% of the time, depending on whether it's a field or correspondence audit. So that's your little sucker punch there. Is yes, the pro is super easy to set up, simple to stop. You just quit filing it. There's not anything with the state that you're worried about. I mean, it's possible to be an LLC taxed as a disregarded entity to operate as a sole proprietorship, which is better than nothing. But from a tax standpoint, it's just putting it on your personal tax return. And the money that the business makes, because nobody can distinguish between you and the business, there is no distinguishing. You don't have to keep it separate. You just literally operate out of one bank account because all that money is going to be yours anyway. You're going to get hit with employment taxes on 100% of your net profit. And that could be a bad thing. If you don't know what employment taxes are, it's old age, disability, and survivors. It's 12.4%. Medicare is 2.9. There's a phase out, and then there's an add in, depending on how much you're making, just to make it even more fun. But what it really means is, say, if you're making 100 grand a year, you're paying 15.3% on that money, and you probably don't have to. Like, you could cut that by 50% or more simply by using an S-Corp, for example. But people don't know that. And when we go and start doing our checklist, you'll see what I'm talking about, because it literally, I don't think it meets any of the boxes. People, bankers don't particularly care to be dealing with the sole proprietorship, because really it's just you. So they're not even looking at the business. They're going to look at your FICO score. They're going to look at your financial condition. They're going to ignore that business for the most part, because it's just going on a Schedule C. And really what they're doing is they're saying, hey, you haven't distinguished between yourself and your business. You haven't set it up on its own. Why would I treat it separately from you? So from a business planning, you're never going to get an investor, for example, to put money in a sole proprietorship. They want an interest in that company. And just by the term of it, a sole proprietorship is one person owner. So you can't have any other owners. Husband and wife in a community property state can be considered one owner. Separate property state, you're considered a partnership, believe it or not. Or you could, there's a little, there's a get out of jail free card on one of those things. There's a workaround, obviously, in most things. If you are husband and wife, depending on whether one person wants to own it and maybe have the other spouse be an employee, there's some things. Now, what are the cons? 100% zero liability protection. In other words, if I set up Toby's Plumbing and I go and I mess up a job and it floods somebody's basement, they can take all my personal assets. They could garnish me. They could follow me around for decades, taking my money or force me into bankruptcy, because there's zero liability protection. There's no distinguishing between you and the business. Now, there is a hybrid where you set up an LLC that's disregarded from tax purposes. That will create that box to protect you from the activities you engage in as a business, but it's going to require some formalities. It's going to require that LLC. It's going to require a separate bank account. It's going to require that you treat it separately and that you don't commingle all your monies, and that you keep separate books and records. And so people that do that usually just take the next step and go right to an S-Corp, because it saves you so much money in taxes. But I'd be remiss if I didn't say that there was that possibility. So people use sole proprietors. Get this, it's about 70% of the businesses out there are sole proprietorships, just because they're so dang easy to set up, and people don't realize all the downsides, but other people do. Lawyers understand it, and the IRS definitely understands it. So let's go through our checklist, and we will do our checks. So let's just say, does it meet asset protection? No. Does it give you any tax benefits? No. You do get to write off your business expenses if you're tracking them, but there are no additional tax. Like there's nothing that distinguishes it from any of the other entities here that makes it better than. Business planning, absolutely horrific. And then legacy planning, there's no difference between you and your business. So when you die, that business dies. There's no such thing as a sole proprietorship that makes it through somebody's passing. It's done, because you are that business. And so from all objective standpoints of somebody who's like in my line of work, I'm looking at this going, this is really horrible. We do use them on occasion because they're so simple, but not for something that's going to hold any significant assets or have any particular value. Sometimes we use it because it's really easy to pay kids, and they're easy to set up, and you can have one spouse be a sole proprietorship and pay minor children. You don't have to do employment taxes. So, but that's a topic for another day. It's moving money over to your kids' tax brackets is way, way, way better. So that's number one, is sole proprietorships. Number two is partnerships. And partnerships from an active business standpoint is just two or more people getting together running a business. So again, it's as easy as it was setting up a sole proprietorship. If two or more people or even two entities get together, they're a partnership. And when they file their taxes, they're filing something called a 1065, which is an informational only return. The partnership does not pay taxes. the partners pay the tax. So it just sends it on down. Now, here's the things. They're relatively easy to set up. They are really good for passive assets. Like I love partnerships for things like real estate, rental real estate, and most people do. Like if you see a syndication out there doing real estate, chances are it's taxed as a partnership, but they're putting it together with an LLC. They're creating a liability protection from others by putting an LLC around it. From a tax standpoint, they want everything to flow through because of the type of activity. They want that to flow through to the individual owners. From a biz planning standpoint, they're fantastic for passive assets. They're not so great for active businesses, and I'll get into that reason in a minute. And then from a legacy standpoint, again, the partnership, just two people getting together being a partnership, there is no benefit. There is no good there from that partnership unless you create that LLC or limited partnership around it. And so I'm just going to be real frank, and I'm going to narrow on to the active business and say this is a typical partnership of two or more people getting together. Really easy to set up. The horrific side to it is you are on the hook for what your partner does. If you do not use an LLC or a limited partnership, and all you're doing is getting together with a friend and starting a business, and they do anything, they incur a bunch of expense on behalf of that partnership, you're personally liable. We've seen it over and over again where people will get together, they'll start a business, one of the partners walks off with all the cash, and all the liabilities are left with the remaining partner or partners, and they end up eating it because they are personally liable. They're joint and several liability for those partnership activities. The other thing is, if you're in a partnership and somebody dies, chances are that partnership just dissolved, right? It's catastrophic to the partnership, especially if it's like me and my buddy and we're doing a business and something happens to him. He becomes like, there's so many bad scenarios I could come up with. Like they get sick, or they're unable to continue to operate in any way, or they move, or they pass away. All those things have a pretty dramatic impact on a partnership when all you're doing is getting together and operating as a partnership without actually having a business structure. It can be catastrophic to the business. It can cause you a lot of problems. The liability is probably the bigger one, as being that joint and several liability for the actions of that partner. And it can be pretty bad. The pros of it is those monies. That partnership just files an informational return, and all of the profits flow down to the individual partners. So again, we love them when we're on that passive side. But since today I'm focusing on the active side, the active business, then again, I'm going to go through and do my checklist, and it's not so great. Let's see. We'll go through this again. Do partnerships offer you any asset protection? No, not unless you stick them in some sort of business entity like an LLC or an LP. Tax-wise, they don't give you anything special in a active business. What they're going to do is pass 100% of the net profit down to you and subject you to employment taxes on the entire amount if you participated in that thing. So I'm going to say they're not doing anything for us from a tax standpoint. From a business planning standpoint, again, if I was talking passive, they're good. From an active standpoint, not so good, because here's the thing. Those two individuals, they're the ones that are the business. Quite often you have a partnership with no LLC, no nothing. It's just two people getting together. No bank really wants to deal with it. It's usually a hot potato. Nobody really wants to deal with it. And then from a legacy standpoint, we have lots of bad scenarios where somebody gets together in a partnership and one of them passes, and you end up with a big mess because you don't really have a agreement on how that's going to be treated. So the partnership automatically dissolves, and you end up in a situation where the business is probably over, or but maybe the surviving partner restarts it and keeps on going. All right. Next category. This is where we're getting into the formal businesses, and this is where we're getting into groups, and people that actually are operating in a business-like manner, and that's the S-Corp. And the S-Corp is very popular amongst CPAs and tax professionals because the tax benefits are so extreme. When you are operating as a S-Corp, for example, and let me just compare them to our counterparts, the sole proprietorship and the partnership, you are able to avoid about 60 to 70% of the employment taxes simply by paying yourself as the shareholder, as one of the owners, a salary. And the rest of the money that comes out is automatically flows under your tax return. And S-Corp does not pay taxes. It passes everything down to its shareholders. But you don't have to pay employment taxes on those profits. And so let's just do a quick comparison. If I'm a sole proprietor and I make $100,000, I am paying roughly that 15.3%. There's a slight deduction. It ends up being right around 14%. I'm going to pay that 14% in employment taxes. Whereas if I'm an S-Corp, I'm still going to have to pay employment taxes, but only on that portion that I take as a reasonable salary, which is generally about a third. That's a rule of thumb. But let's just say, again, we'll use our example of $100,000 and we're going to pay ourselves, let's say $30,000. That's the only money that's subject to Social Security taxes. The extra 70 avoids it. And if we could do math, of 14% of 70,000, what's that? Somewhere in the neighborhood of $10,000 is what you're going to save simply by being that S-Corp. So from a tax standpoint, they're fantastic. Another thing that makes them, that's a big pro, is because they're set up as a separate business, they offer you liability protection as one of the shareholders. So they're fantastic from a standpoint of isolating the business and making sure that if something happens in that business, that it doesn't come get you. So again, using the example of Toby's Plumbing, let's say it's Toby's Plumbing Incorporated, and I'm operating as an S-Corp, and I make that same mistake and flood somebody's basement. They can sue the business, but they can't sue me individually. They would sue the business and say, that's the responsible party. Me as an individual, I was not, like, as long as I'm disclosing, hey, this is Toby's Plumbing Inc., you're dealing with a business and blah, blah, blah. And we don't do anything crazy. We don't intentionally do anything. There's no reason to pierce the company. If I'm just operating as a normal business, you're going to be restricted to the four walls of that business. So that box, that S-Corp, which means I'm not going to get followed around the rest of my life, getting garnished. I'm not going to have to deal with it. So they're fantastic. Another reason that we use S-Corps is because when you are a shareholder and an employee, I cannot be an employee of my own sole proprietorship. I cannot be an employee of my own partnership by definition, because it's not a separate business. I am a proprietor or I'm a partner, and I do not get to take salary. If I am an S-Corp, however, and I'm a shareholder of an S-Corp, I can be an employee of that organization. And then I get something called an accountable plan, where it can reimburse me for expenses that I've incurred on behalf of that business, including like an administrative office in my home or using 280A, they call it the Augusta rule. All these really cool tax strategies that allows me to get money into my personal realm, tax-free, that is tax deductible to the company, that nobody has to pay tax on. And that's perfectly legal. And in fact, it's actively encouraged. It's all over the code. They want you to reimburse employees for expenses that they incur on behalf of the business. I'll use an example. Let's say that you're working for a business and you have one of these little phones, right? And they say, hey, you have to have that phone and we're going to use it for the business. That business needs to reimburse you for the cost of that phone, needs to reimburse you for the cost of the data and the cell. In fact, there's court cases where workers got together and said, hey, you can't just take something that I am paying for. You have to reimburse me for the expense on it. And the courts actually said, yes, the business has to reimburse. You're making it a condition of employment or required. It needs to reimburse me. Well, here's the beautiful part. If I have one of these phones and I'm an employee of my S-Corp can reimburse me for the whole cost of the phone and the data and the cell, so long as I'm using it for the benefit of the business. Even if I'm using it personally on the side, I could be using it. There's no test that says, hey, it has to be more than 50% business use. Nope. It is just, is the business benefiting from it? The business can reimburse me and write the entire amount off. So there ends up being quite a bit of a difference between sole proprietors and partnerships in that S-Corp. From a tax standpoint, that's a big pro. What about the cons? Everybody hears about S-Corps and they immediately think, oh, complex. There's a tax return that's required. Yes, there is. It's called 1120S. But when you put it side by side with either the 1065 which is the partnership, or the Schedule C of your 1040. I actually do a test when I'm doing live events, and I'll hand out the Schedule C and 1120S and say, which one's more complicated? And most people say the Schedule C, or they'll say it's equal. They're almost identical. The Schedule C looks a little more complicated, honestly, when you look at it, because there's lots more categories on it. The moral of this story is that it's not overtly more complicated than the counterparts. It's actually the same data is being reported regardless of whether you're a sole proprietor, a partnership, or an S-Corp. It's just that you're doing that separate tax return, but the actual reporting of information is almost identical. And so you look at it from a tax standpoint, a prep standpoint, they're about the same time. Maybe that you're working with a preparer, and they're, maybe they're going to hit you for an extra return, but they would be doing that anyway because it's going to have to be reported. Even if you're just a sole proprietor, they're still putting that information on a Schedule C. They're still going to charge you for that extra Schedule C, period. So there's not that. Formality-wise, I already went over this. The IRS looks at them the same. They don't care whether you're an S-Corp, C-Corp, partnership, or sole proprietorship. You're still required to do books and records, period. The compliance is the exact same. So it does not matter from that standpoint. Some folks say, well, but if you're a corporation, you have to keep a paper trail. Yes, you do. But it's the same with any business that you have to keep the paper trail. So my point is that the complexity, even though it looks, and a lot of people say it's more complex, realistically, it's not that much different. The biggest difference is you're going to have to run payroll. And you're going to have to run at least one payroll to yourself every year if you're taking money out of it. So if you're taking distributions of any kind out of that S-Corp, you got to make sure you're taking a reasonable salary. If you're not taking distributions, then that's off the table. Other things that people use the S-Corp for, now, because they're a separate business, from a business planning standpoint, banks treat them separately and they treat them differently. And so it can develop its own credit profile. There's business credit bureaus, just like there's individual credit bureaus, and it can start to stand on its own 2 feet. So I would say that there's additional operations and additional opportunities to raise capital when you're sitting there and you're operating as an S corporation. Now, as a downside, not everybody can be a shareholder of an S corp, and they're limited to about 100 shareholders. And so if you have people that live outside the country, they're non-residents, non-U.S. citizens, can't be a shareholder of an S-Corp. If I have a C-Corp that wants to be a partner in an S-Corp, can't do it, right? There's certain restrictions on the shareholders. It needs to be, typically it's natural person that's a resident of the United States, right? So, but for the most part, it's never an issue unless you're going out there and actually raising money and growing a big business. In which case, you're probably going to drop down and end up becoming a C-Corp, because that is an easy solution. But let's go over the check marks on that S-Corp before we get there. So I'm going to jump back up. S-Corporations absolutely give us that asset protection. You cannot have an S-Corporation without at least setting up an LLC or a corporation with the state. There's no such thing as a sole proprietorship that is an S-Corp. Right, you actually have to take that step with the state. Tax-wise, saves us a bunch of money, especially if we're in an active business and it's making a little bit of money. Let's say anything over $30,000 or $40,000, you have major tax benefits of being an S-Corp. From a business planning standpoint, now the IRS, or not the IRS, but now the banks and angel investors, everybody else is looking at it saying it's a separate business. This is great. It's separate from you. We don't have that same, hey, a partner could make a decision and it could haunt you forever, because we've restricted the activities into that box that is that S-Corp. From a legacy standpoint, you now have shares. It does not die with you. If I pass away, the S-Corporation keeps running. It's not tied to me. They go on forever. They have perpetual existence. So I can just give my heirs my shares. The business doesn't have to shut down. It doesn't have to dissolve. There's none of that nonsense that you get when you have a sole proprietorship or when you're operating as a general partnership. So the S corporations check all of the boxes. That's, again, while I would guess that if you went to a CPA or a tax attorney and you talked about setting up your own business, 90% of the time, they're probably immediately going to an S-Corp because it is the best vehicle for active businesses. If you're relying on those funds and you're taking those funds, and especially if you're a consultant, an attorney, a doctor, you're somebody who's making good income, almost always you're going to be an S-Corp or an LLC taxed as an S-Corp. If you're a real estate agent, you probably have to be, depending on what your licensing is. But the vast majority of businesses, when they are real businesses, they're going to be set up and they're more than likely going to be taxed as an S-Corp. And I mean, to throw a couple other things out there for you. S-Corporations are audited. This last year, it was a asterisk. It was less than 0.25%. You just don't see them getting picked on. And the reason being is because they have so many tax benefits. The IRS is really looking for money. And why would you go to something that already has a whole bunch of tax benefits that keeps somebody from having to pay taxes? Why would you audit that? I'd much rather go after the sole proprietor and try to get monies from them. And realistically, the IRS really does audit one group more than any other, and it's literally 13-1. And that group is folks that are poor. That's because they don't fight. They pay extra taxes and they don't hire attorneys and accountants. So unfortunately, the more complex you get, the less likely it is that you're going to get audited. And the reason being is because you have people around you, guys like me, who are going to help make sure that you're dotting your I's and crossing your T's. And that's just the fact of the world that we live in. If you're somebody that can't afford those things, chances are you might end up being a target because you're easy pickings. And it seems unfair, right? But when you look at the numbers over and over, that is the God's honest truth. And if you don't believe me, go check out Syracuse University does a tracker called Tracks, and it shows, I think it was 13.3 audits per thousand for folks making earned income tax credit or less than $25,000 a year. And then for everybody else, it was like 2.2. It's night and day compared to them. All right, let's get to the C-Corp. So a lot of you guys have heard C-Corp, and the first thing that comes to your mind is a big con, which is double taxation. I want you to nix that out of your mind. Double taxation, when you are running an active business and you're the one running it, is a choice. You do not have to pay dividends. You could pay out just salaries, or you could accumulate those funds. If you're growing your business, that's absolutely something that you can do. And the beautiful part about a C-Corp is that they are taxed at 21%. So especially for high net worth folks that have high incomes, or just high income folks. Hey, I have maybe a spouse is a surgeon, they're making $600,000 a year, and I'm making $150,000 as a side project. If I make that 150 and I top it onto the 600, I'm in the 37% tax bracket. If I'm in California or New York, I'm closer to 50%. Maybe I will just keep it in a C-Corp where it's 21%. Maybe there's some state tax on top of it, but it's a much lower amount than if I was to earn it individually. And that's why people use C-Corps. The other reason they use C-Corps is because there's additional tax benefits from a C-Corp. For example, C corporations can reimburse you if you're an employee or an officer or director as an employee. They can reimburse you 100% of your medical, dental, and vision costs, including co-pays, including deductibles. You could have insurance from an employer. And if you're coming out of pocket, it can literally reimburse you 100% of that. Now, there's some nuances there, so make sure you work with an accountant. But you can add, that's one of the huge benefits of it. So it pays its own tax, and it gets additional tax benefits. And then everything else we talked about with that S-Corp and accountable plans applies to the C-Corp as well. So it could reimburse you for using an office in your home, which is much better than a home office. And it's not reported anywhere on your tax return. It's tax-free money. It could do 288, where it's using your home to have meetings. You can do it up to 15 times a year. I would just say 14 to be safe. 14 times a year, it can reimburse you. It's less than 15. So 14 times a year, it could reimburse you for meetings in your home. And you don't have to pay tax on it. You don't have to report it. And the company gets to reimburse the fair market value of those expenses if you're having meetings in your home. Now, what's the con of a C-Corp? They're always saying, well, it's double taxation. Oh, they're horrible because you're gonna pay tax twice. Well, here's how it works. You pay tax at the corporate level at 21%, and then if it pays the profit out to you, you pay it as long-term capital gains because the dividends are qualified dividends. In English, that just means that when I actually run the numbers, let's say that I was making $500,000, or I'll use a better example. Let's say that you're in the top tax bracket and you make an extra 100 grand. If that went into my personal tax return, that would be at 37%. If I let the corporation keep that money and they paid 21%, let's just do the math. So it pays 21%. So there's $79,000 left. And then I paid that out to myself as a dividend. It's going to be taxed at, what would that be, about 20%, the long-term capital gain rate. Maybe the net investment income tax would also, because if I'm in the highest bracket, I'd have to throw that on there. But it's right around 23, 24%, or 20% if you want to just use the capital gains rate. End of the day, it's right about the same amount of money that you're paying in taxes. In other words, I've done the math on this a million times, and rarely are you in a situation where it causes you any significant harm. That used to be different. Before they changed the rules years ago, it used to be that dividends were taxed at your ordinary rate. So that could be, ouch, I got hit at the corporate rate, which used to go up to 39%, and I got hit at my ordinary rate, which used to go up to 39.6%. I could get splashed with tax liability. Ouch. That's not the case anymore. The way they do it, it's a flat tax at 21% plus long-term capital gains rate. So let's say that you were somebody making, I don't know, 100 grand a year. Fantastic. I'm going to pay 15% any dividends that I pay out. So when I add up the money, it's right around a 33, 34% tax bracket. It's not going to be markedly different than if I had made that money as a sole proprietor. So I want you to get that out of your head. I've been doing this a long, long time. We do over 10,000 returns a year, and I could count on one hand how many times we've seen issuance of dividends, and especially issuance of dividends that were not intended, right? Like, oh my gosh, we're going to have to issue this money out, and we didn't expect it. No, you're doing everything very deliberately. This is not a situation where it trips people up when you have an accountant. They know what to do, because if you end up with the extra money and you're just sitting there going, I don't want to have double taxation, fantastic, pay it out to yourself. Do a defined benefit plan, put it all into a big old retirement plan, or do a 401k, or just pay it out to yourself. Worst case scenario, you're no worse off, right? So if I paid it out to myself as a salary, okay, it's ordinary income, subject to employment taxes the same way as if I was a sole proprietor. I'm no worse off. So whenever I look and listen to those things, I'm always like, gosh darn it. But what a C-Corp does give you is added tax benefits and liability protection. And there's no restrictions on the shareholders. So that's why you see publicly traded companies always form as C-Corps and then go to the market, because anybody can own those shares. And then from a legacy standpoint, they're absolutely fantastic, because just like if you owned, let's say you had a grandparent that owned shares in GE or something like that, the shares just pass down. Right? There's nothing that happens to the underlying business. So if you set up a business as a C-Corp, fantastic tool for a legacy plan as well. So let me go back to my chart, and this will be the last one that we go over. And again, you're going to see a trend. Asset protection, absolutely fantastic. Separate from you, requires that you set something up with the state, but it's not you. Tax-wise, you even get better tax benefits than the S-Corp, right? They're absolutely fantastic vehicle. Biz planning, premium again. This is where people go public. They're always taking C-Corps public. That's why, because, again, they're easy to underwrite. The banks like to do business with it because they understand it's different than you, and it's not just flowing into you. It's not just a conduit. A lot of times they get a little nervous, especially big banks. And if you're doing a big money raise and it's an S-Corp, because you can just take the money out. With the C-Corp, there's going to have to be a reason for the money out. But it's a great vehicle. And then from a legacy standpoint, again, you own shares. It's you and your business are separate. You've created that division. And so you can actually do a compare and contrast. Realistically, the corporations are obviously the best. The sole proprietor, you could make this a check with an LLC. You could make this a check with the partnership if you did an LLC or an LP. but the other ones by far and away that it's going to be night and day. So when you are setting up an active business and you're deciding how to set that up, that's the analysis you go through. And you look and you say, what are the pros and cons of doing different types of businesses? You look at audit rates. You look at what will happen if something occurs, unexpected events occur. What happens if like in a C-Corp, if your shareholder does something stupid, it doesn't affect you. In a partnership, it certainly can. If something happens to you, what happens to the business? In the corporations, obviously they're protected. In the sole proprietorships and partnerships, you have issues. And so everything, when you were just going through and check, pros and cons, listing them out, obviously it becomes very, very clear why wealthy people and successful people constantly end up using S-Corps or LLCs taxed as S-Corps, C-Corps or LLCs taxed as C-Corp. By far and away, the most successful businesses out there, including everything that's on that stock market, just about. Like there's some master limited partnerships floating around out there, but for the most part, every major business you're going to see as being a C-Corp, and there's a reason for it. And just about every successful small business is going to be some sort of S-Corp. There's a reason for it. And there's a reason that a lot of folks avoid operating active businesses as partnerships and sole proprietors. And obviously, we just went through a whole bunch of them, and now you know why. If you like this type of information, please share it with others. Please like us. And if you leave a comment, tell me what you'd like me to cover next. I always go through and read it, and I do like to make sure that I'm answering your guys' questions. But if you have some good ones, I'll make it into another video. Just leave me your comments below. Thanks, guys.